Nervous. I should be the one nervous.
Oh no. You do this stuff all of the time. All right. Let me see if I can restart my live feed here. Okay.
I gotta grab a charger for my phone. I'll be right back.
Okay, solid good. I do like the platform, but there's some times where my technical inexperience shows.
Well, we all start from there. You know, I had no clue what I was doing, and I still, fumble with different software applications, but then you learn it, and then it becomes easy. But it's in the beginning, it's a little bit of a challenge.
Yeah.
So, what do you go by? Is it Delisa? Delisa. Okay.
Okay.
Hey, Darin.
Yes.
Hey, Darin.
Hey.
All right. So we are officially working on all of our platforms. I want to officially take a minute, Darin, and let you know I am so appreciative of your time. Out in Texas, I know you guys 7 o'clock right about now. And, one of the things that I've always believed is that when you have an opportunity, you got to seize it. So, the way I met you, Darin, is me and my real estate buddies were doing some outreach. And I believe what happened is you responded and you were like, yeah, I would love to, share some information. And literally I got the information handed it to me. I had no idea what your background was. You weren't a wholesaler at all.
No.
And so when I started doing some research and learning more about it, there was a level of infinity for me because that was something, that I kind of see as a place that I want to be at down the road. And
Fantastic.
so Delisa was like, wait, hold on. You have a very, very focused platform. People follow you because you give them tips and tricks on how to start a real estate investing operation with little or no money, which is the magic of wholesaling. But I also realized that wholesaling is the gateway drug of getting yourself in the door, and there's so many other pieces to it.
Sure.
So I'm really excited. We got a ton of questions that we're going to share, and I want to just kind of kick it off by just letting you know I don't take your time for granted. So my first question, kind of moving into this, is tell me a little bit about your background in terms of how you got involved in your entrepreneurial journey.
Okay. First of all, thank you for having me here. I'm always open and willing to talk and share because other people did it for me. So I just got involved in real estate. I'm 50 years old. So there's a lot of other. You too. Well, happy birthday. So I still feel like I'm young, but I didn't get involved in real estate until about 3 years ago. And I had people that helped me along the way. I did not go the wholesaling route. So this discussion will not be as much geared towards wholesaling as it will be investing in multifamily properties, because that's my experience. But leading up to that point, I kind of did the corporate thing. I was a CPA at a school, Price Waterhouse. I traveled with PepsiCo. I did software sales for a number of different technology companies. And then I was on an institutional loan trading desk for a large multinational bank back in the 2002 to 2006 timeframe. 2007, I went and started my own company. So that was when I got out of corporate, started my own company. I still have that company, which gave me freedom of time. So I raised my kids. I was able to, coach all my kids' games and go to all the practices. And, I was my own boss. So that gave me freedom of time. But the piece that I missed and the piece that I really love about the real estate side is the wealth building. So, I grew up with the mentality that, and it's just the way that most people are raised and taught in school, get good grades, go to a good college, get a good job, climb the corporate ladder and put 10, 20% away in some kind of retirement vehicle in the stock market. And then magically it's just going to grow over time into this massive nest egg, right?
Almost like they say, just, plant it and water it and it'll just grow.
Yeah. It'll just, just put it out there and you don't need to know anything. You don't need to do anything. Just, it'll just grow. Right. And so here I was 47 years old and, it did grow. Okay. But not anywhere near to the level that I thought it was going to. And so, I had heard that, 90% of millionaires are created through real estate. And I was like, it's about time for me to get involved. So my wife and I went out and bought a new construction duplex. And that was October 2017. It was going to take a year to build. And I was glad I bought it, but I was like, this is going to take forever, buying a duplex and a fourplex and an eightplex. And so I was in search mode for how can I go bigger? I didn't know how to do it, right? But I did know I wanted to go bigger. So I went searching. I ended up going to a few local RIA meetup groups, and they were more single family, fix and flip and wholesaling, which is, your group. And it just wasn't something that I wanted to do. So I then kept looking and I ended up finding a group that was focused on large scale multifamily. And, I went to this meetup. I still remember it. It seems like small little trivial things, right? Is taking one little action step, whether it's coming on your show and listening and learning something or going out and meeting people. It can be scary at times. You're afraid like they know more than me and, I'm going to look dumb or sound dumb, whatever. So I go to this meetup group and there's probably only 25 people. It's a Saturday, 1:00 in the afternoon. But first thing I do is I meet this couple that's, a little older than me. They were probably in their 60s and they're like, look, Darin, we were in the same situation.
So I go to this meetup group and there's probably only
Sorry, that's my backlash.
But first thing I do is I meet this couple.
I'll wait for you to turn that. Good.
Yep.
So I meet this couple and they're like, Darin, I was in your same position and I joined this multifamily mentorship group. They helped me, get through the steps. I bought my first multifamily property and they were so open about like how much they made. They were like, I made like 300 grand on the first deal. And then they bought a bigger property and they made like 600 grand. And then they bought a third property and they made over $1 million. And I'm like, that's crazy how fast and how much wealth you can build in a short amount of time. Mm-hmm. So I was like, I'm in, if they can do it, I can do it. And that was what kind of got the ball rolling. So that was, December of 2017 is when I joined that group.
Wow. Okay. So then I'm gonna kick the next question over to Alicia. But if I'm hearing you correctly, you've been in real estate less than 5 years.
Absolutely. Just less than 4 years, like 3.5 years, less than 3.5 years.
Wow. Okay. Excellent. All right, Alicia, you got it.
Okay. So what is the basic process of purchasing and profiting from multifamily residences? Because a lot of the people here don't have the resources. Did you have to come up with a lot of money? How did that work for you? Yeah.
So there's a few kind of answers that can come off of that question. First of all, like how do you, what's the difference in large scale multifamily versus like single family? Single family, in order to, how it's valued is based off of how other properties in that neighborhood are trading,
Mhm.
right? So if you find a property that needs to be fixed up, you kind of look at the, after rehab value, right?
Right.
And then you build in your profit. But it's going to sell for around where the other properties, like properties, are. So multifamily is different. So when you get into 5 units or greater, and we kind of focus on 60 units or greater, you could have 2 multifamily properties that are right next to each other, that were built the same year, that
Mhm.
look the same.
Mm.
One
But
is
not valued the same.
right. They're valued off of the actual cash flow that the
Right.
property generates. So if one is mismanaged and the other one is managed well, then the one that's managed well is going to be valued higher because it's bringing in more cash. Okay.
Right.
So the premise is really to find properties that you can purchase and also raise additional capital, and then take that additional capital and put it back into the property to increase the value. So that might mean painting the exterior, or it might mean, hey, look, all the interiors are like 20 years old. So if we
Mhm.
upgrade the interiors, I know by looking at other properties in that submarket that if I upgrade to this level, I should be able to get another $100 in rent
Right.
per unit. So
Yeah.
that's kind of the business plan. Now, in terms of, okay, how, it is different than wholesaling, where, wholesaling, you can pretty much, little money on your, from your side, and then you sell the deal to somebody else, to an
Right.
investor. In multifamily, you need one of two things. You either need some capital,
Mhm.
or you need to put in the sweat equity. Now, in wholesaling, that's what you do, man. You're putting in the sweat equity. You're the one that's finding the deal, right? You're out finding deals. So our business is all about finding deals and finding investors. So what I didn't understand before was that, I always thought that these big apartment complex, 100 unit, 200 unit, 300 unit complexes were all purchased by institutions.
Mm-mm.
But they're not, right? They're
No.
purchased, a lot of them are purchased through what we call the syndication model. So you have some general partners. It could be one person, 2 people, 3 people,
Mhm.
that they go out, find the deal, and then they raise capital from other limited partners. And all syndication means is a group of people coming together to buy an asset they couldn't buy on their own. And so that's how I got started. When I joined, I pulled money out of the stock market and I started to invest passively. So I was a limited partner at first. So I went and met other people that were actually putting the deals together, and then I would invest with them. And the typical investment in these types of deals ranges from, typically the minimum is like $50,000. So 50,000, 75,000, $100,000. And so on a deal, maybe you're raising 3 million and 50,000 to $100,000 increments. Or maybe you're raising 5 million or 10 million or 2 million, whatever the requirement is. But it gives you the ability as the general partner to really scale. And, to give you an example, so my duplex, my wife and I bought, was 290,000. We put in another, say, 10,000 in fencing. So we're in it for 300 grand. We put in 45 grand, and then got a loan for the remainder. And then when I got involved in the syndication model, I purchased a 76 unit deal, okay, which was a $6 million purchase. I partnered with one other gentleman that had a lot of experience, a gentleman by the name of Raj Gupta out of Chicago.
Mhm.
And my wife and I invested 100,000. Okay. And we raised $2.5 million from other people. So 50,000 in a $300,000 duplex, 100,000 in a $6 million purchase.
Mhm.
You know, so it gives you the ability to really scale.
Mhm, mhm. Yeah, and that was interesting. That was my next thought, is the process of you scaling up. In 3 years, you guys have moved like rocket level. How does that work in terms of raising funds and getting connected in the syndication? Tell me more about that.
Sure. So I would tell you guys, and I would tell your, viewers that it first all starts with mindset. What do you believe that you can achieve? If you don't think that you can buy a 76 unit community, like you're not going to be able to do it, right? You have to believe that you can do it. And then you have to make a decision that you're going to go after it. Okay. Once you do those two things and nothing's going to stop you, then you're on a mission to meet the right people to make it happen. Okay.
Mhm.
And you need to, first of all, meet a partner that has experience, because in the large scale multifamily world, like I wouldn't have been awarded that deal. It was a very competitive deal. I wouldn't have been awarded that deal if I didn't have my business partner who had already purchased 100 unit plus deals, rehabbed and had experience.
Makes sense.
So you first need to, whenever somebody reaches out and says, what's the first step? I say you need to get like 4 or 5 experienced partners that say, you know what, Earl, if you find a deal that I'm interested in, I would partner with you. You need, and I've had some people say, I got one guy that will do it. I'm like, you need more than one guy. And here's why, because you might be going after a deal, you end up getting in best and final, you're close on that deal, and you've spent maybe 6 weeks working that deal. You've built a reputation with the broker, and now all of a sudden you call your guy.
Mhm.
He's like, Earl, man, I want to do this deal with you, but I just said yes to somebody else 2 weeks ago. I'm raising capital on that deal, and I just can't do 2 at the same time. Like the guy isn't trying to blow you off, but he's in on another deal. Well, you have to be able to pick up the phone and call your number 2.
Right. That makes sense. Yeah.
If you don't, you're going to lose all credibility with the broker. They're never going to show you another deal.
Right.
Got it. Got it. Thank you. Thank you.
Absolutely.
You got the next question, Talisha?
Where do you find these deals?
So the large scale multifamily deals are typically all through brokers. So I'm in the Dallas market. There's 8 to 10 broker groups, in each of those companies. There's multiple brokers but there's 8 to 10 broker group companies that they pretty much control the large scale multifamily market. Now they may have off market deals and they have on market deals. And there's pluses and minuses to both. But predominantly both the off market and the on market deals are going to come through those 8 to 10 companies.
Okay. Now, do you only buy in Dallas?
So I'm focused in Dallas because I love Dallas. I love the Dallas market. It's a great apartment market. I have invested in other markets in Texas. I've invested in Houston. I've invested in San Antonio. Austin's another great market, but it's just difficult price wise. It's more expensive. So what do I classify as good markets? I live in Texas, so I don't really, and I think Texas is an awesome market, so I don't want to go outside it right now. But any of the other growth markets, like Arizona, Phoenix is growing like gangbusters.
Mhm.
Florida and Tennessee and Charlotte and, you know, Carolinas, Georgia, great growth markets. So what I look for in multifamily is, population growth, household growth, job growth. And when you see that, why is that important? Well, that's competition for those apartments. If more people are moving in, it's going to put pressure on and more competition on those apartments, which will, should help, the rent escalation.
Okay. What's your typical profit margin that makes you say, yes, I want to do a deal?
So I'm in a multifamily mentorship group, and we all use the same kind of underwriting spreadsheet, and it's really focused on the investors. Like, so what's in a return that is going to be attractive enough for somebody to want to invest 50,000 or 75,000 or 100,000, right?
Gotcha.
So it moves with the market. Right now, I'd say total return of like 70 to 80%, over the business plan, which most of the deals are built off of 5-year business plan. And that will be a split. That return will be split up between cash on cash and a back end capital gain. So, if you want to say somebody invests 100,000, and let's just use the 7% cash on cash, so let's say they get paid 7,000 a year for 5 years. They've invested 100,000. After 5 years, they've been paid 35,000, and then a forecasted $35,000 capital gain on the back end. That gets them 70,000 return on their $100,000 investment.
Okay. Sounds good.
All right. That was that question was awesome, because for my folks who follow us, they know the numbers are the most important thing, and trying to bridge your matrix, or the numbers that matter for you guys was a great question. In the world that we kind of play in, everything is driven by ARV.
Right.
So, what's the ARV of a property? Okay. What's the rehab cost of that property? And, what percentage of that ARV can you acquire that property? For someone who is more of a creative finance investor, which is the Lisa's specialty, she's looking at cash flow. So I was interesting to kind of hear how those numbers are connected. What other numbers matter when it comes to evaluation, and how do you break down those analyses?
So as I was alluding to before, these properties are valued based off cash flow. So the big number that everybody looks at is what's called net operating income. So you're taking all your rents, and possibly other income, which, you may be charging for pet fees or for billing back for utilities, whatever the case may be. You have a total revenue line, and then you're going to have expenses. You're going to have payroll expenses. You're going to have utility expenses. You're going to have property taxes. You're going to have insurance. And then, the bottom line, you're going to have total expenses. Then the revenues less the expenses is going to give you your net operating income. So your net operating income is before paying your debt service, before making the mortgage payment. Okay. That number is where the valuation comes from. So you're always looking, in these multifamily deals, you're always looking for, how can I either increase my revenue by increasing rents, or how can I decrease my expenses? Either one of those two components will increase the net operating income, and then the net operating income will then increase the valuation of the property.
Right.
Thank you.
Those are the numbers I have to look for. I'm not sure if Earl told you, but I'm a licensed broker here in New York.
Oh, okay. No, he
So-
didn't. He didn't mention.
So, yeah, I know the numbers. The, because the 90% of my client base are investors. So these are the numbers they're always asking me, well, what's cap rate? What's the operating expenses? What's this? What's that?
Right.
Or you present them with a deal. So that's why I wanted you to explain it, because Earl's audience may not understand. And I'm glad you broke it down the way you did, because his audience may not understand how to calculate net operating expenses
Right.
or income. So they don't understand that. And they don't, and a lot of people have a time trying to figure out gross versus net. And even as adults who get a paycheck, and you say, well, net is what you bring home.
Right. Right.
They're like, well, I don't bring it home. It goes to my bank account, but you still have access to it. It's the money that you have access to. It's the net.
Absolutely.
Yeah. So we go into a lot of that. Now, you said you work primarily, you mentioned some growth areas, and that struck me because I'm getting ready to expand my brokerage to Atlanta.
Yeah, I think Atlanta is a great market.
Absolutely is. Now there's dang on it, getting old, because I'm getting
Hey, come on
old.
now. You just called me old. I still think I'm young. Come on now.
I'm very young. I tell everybody I'm still young. Now, for the people who might be a little slower, other than 401k loans, explain your pitch for OPM, which is other people's money.
So I don't really look at it as a pitch. So to me, it's an opportunity,
Right.
So I remember, my wife was like, hey, don't go to personal friends and family on the first syndication deal. And I'm like, why? Because she's like, well, what if the deal goes bad? You don't want to break those relationships. And I'm like, look, we're investing. I've been busting my butt out there. I believe in this deal wholeheartedly. And why am I going to only want people that I've met through this multifamily mentorship group to benefit from that?
Right.
I want to present the opportunity to friends and families and colleagues, ex-colleagues, and if they're not interested, then no harm, no foul.
Right.
So I look at it as an opportunity. So, where else can you get the returns?
Exactly.
And
I say the same thing when I'm pitching my deals.
And
I say, you're not
have
gonna get that money.
capital preservation and,
Yep, you're not gonna get that.
reduced risk.
You're not gonna get the ROI anywhere else.
I just wish I had started doing it earlier. Now, the thing that is scary is like, look, if you go buy stock, you could buy $1,000 in a transaction or $5,000, right? One transaction, boom, you're done, right? And you could sell it tomorrow, right? With these multifamily deals, $50,000 is a lot of money. $75,000 is a lot of money, and so many people. Here's the thing that I've learned is that so many people, it's just natural, okay, that people are more afraid to lose than they are willing to take a risk to win.
Yeah.
And
I'm in a stock trading group, and that's the one thing I said. I just literally posted that today. I said, you guys are focused on the wrong part of this. You're focused on, and what we use is somebody who started a small account, $500. They started the account with $500, and then the next day they earned $1,500. So now they have 2,000, but then the day after that they lost another $1,000. They don't look at it as I'm up 5. They're looking at it as I lost 1,000.
right.
Stop doing that. I don't care what you invest in. I don't care what you're doing. The mindset of an investor, you have to adapt to the mindset of an investor in order to be successful in real estate investing. I don't care what it is. I don't care if you're wholesaling. I don't care if you're buying 8-story buildings with 50 million apartments or skyscrapers in New York City. You have to have a certain mindset. And in the back, and you have to have 90%, yes, it's going to work. And you have to have that 10%. This might not work, but I'm going to make it work.
Mhm.
That's that.
And
What
people
you
just don't
said right
understand that.
there is huge, is stop thinking about, what if it goes bad versus, hey, what do I need to do to make it go good? Right.
Absolutely.
Mhm.
And, there's a lot of in the large scale multifamily, 'cause I'm going to talk about that more so because that's where my experience is.
Mhm.
But there's a lot of checks and balances, so
Yeah.
say Darin goes out and I found a deal and I underwrite it and I make the spreadsheet look all fancy with a nice return and I show it to my business partner, one of the 5 that I'm going to call.
Mhm.
Look, and they have a 5, 10, 15-year experience and reputation, and they take a look at it and they're like, Darin, man,
There's too much fluff.
there's a lot. This is like pie in the sky. I'm not interested.
Right.
Like I'm not putting my name on that. So, the first thing is the first syndicator that's finding the deal. Then he's got to attract partners. Okay. Those partners have to review that and get on board and get excited about it and think that it's a good opportunity and put their name on it, and believe that the returns will be there.
Mhm.
And then these deals are financed, so they're typically anywhere from 70 to 80% financed.
Mhm.
And in the large scale multifamily world, the biggest lenders are the agencies, Fannie Mae and Freddie Mac. And I've seen chart from these guys that over like I don't know, the last 50 years or something of multifamily investing, and they probably have 40 to 50% of the market in large scale multifamily.
Yeah,
And
they're trying to take over.
yeah, and they have the most attractive terms. Now they lock you in with difficult prepayment penalties. That's one of the downsides, but they have all this data. Okay, so they don't know, Darin. They don't know my partner, but personally. But when we send them all the data, right? They have data from all over the country. Okay, in good economic cycles and
Mhm.
bad economic cycles. And if they come back and they approve a loan, okay, at what we were expecting or greater, that just gives me that much more comfort. Like, here's another set of eyes. These guys do not want to do a bad loan.
Right.
Okay. When I looked at their data, I think that before the big recession, the Great Recession, so before kind of that 2006 to 2010, 2008,
Mhm.
2009 timeframe, they
Or
were
Dodd-Frank.
their 60 to 90 day delinquency was like 25, 35 basis points. Delinquency, not defaults, less than 1%. In the Great Recession, we would expect it all to go up, correct? And it did. But even at the height, it was like 85 to 95 basis points.
Right.
Delinquency, not default. So that tells you, one, they're conservative. They don't want to have a ton of defaults. They want to write loans that they believe that the property can sustain. The
Right.
cash flow from the property can make the mortgage payment.
Right. So they don't really rely on the whole Earl, stop sending notifications. They don't really rely on the
Sorry.
they don't rely on the personal guarantee of the company. They're more relying upon the numbers.
Correct. They're looking at the existing cash flow, and then they're also looking at the experience level of the general partnership team.
Yep.
So,
That's how
and
my lenders do it too.
yeah. So They look at those two factors and they're like, hey, look, that's why you have to partner with somebody that's, been there, done that, because they have that track record and they look in their database and they're like, man, this other guy, Darin's partner, Raj, is on like 5-10 deals and they've all gone well. So, that gives us a comfort level.
Okay. Now you mentioned a mentorship.
Yeah.
How does one go about getting into that?
So I belong to one in the Dallas market, Brad Sumrock. So you can look him up, bradsumrock.com. I've also met great syndicators from other mentorship groups. There's Jake and Gino, there's Rod Khalif, there's Joe Fairless. And some of these guys have podcasts too. I have a podcast, but Joe Fairless has a great podcast, Rod Khalif, Jake and Gino. So these mentorship groups, are the value to me was the network.
Yep.
So when I joined, all of a sudden I met all these people that had 2, 3, 4 multifamily deals. And when I'm talking about multifamily deals, not like the duplex that I bought, like
Right.
120 unit, 250 unit, 175 unit. And I'm like, I'm in a room with all these people, and believe me, they're nice people. I'm friendly with a lot of them, and I have a lot of them come on as guests on my podcast. But what's comforting is you look at it and you're like, look, if they can do it, I can do it.
Yep.
So you surround yourself with people that have already done it. You get that confidence, and then you start asking, like, how'd you do it? What were the challenges? What partners did you use? Like what
Right.
lenders did you use? What attorneys did you use? What property management companies? So in the large scale multifamily space, that's where it gets really interesting, is that you can hire full-time property management. So like we have a full-time leasing person and a full-time maintenance person. I'm not writing leases. I'm not, getting a phone call in the middle of the night. I'm not having to, deal with evictions. I'm not having to fix toilets, when they go
Right.
out. The property management company does that. Well, that gives you the ability to scale, because once you buy one property and it's running efficiently, like you still have to manage it as the asset manager, but once it's running efficiently and it's stabilized, then you can go out and get the next deal. And then the property management's buying it. So I have never done wholesaling. Okay. But I know people who have. And from what I understand, it's very transactional, right? So you're out finding a deal, then you find an investor, you flip the contract over to the investor, you make your profit, and now you're out hunting again, right? Well,
Yes and no.
it's yes and no. Okay. So in multifamily,
I have more of a syndication with my wholesaling.
so to
I
explain
don't do
how that
I
works.
don't do a lot of hunting. I have more people that call me to sell their homes than I do that I actually have to go out and look for the home.
Gotcha. And then
And
you
I have a database of buyers.
so then you
that are
just
ready.
are connecting people, and
That's
then
it.
you're getting a profit for doing that.
I'm an extension cord,
Yeah,
bringing people together.
that's good. That's good. Good for you.
Yeah, I was literally doing my profit and loss statement this morning off of my wholesale deals, and I'm like, wow, okay, who knew I made this much money doing wholesaling?
That's awesome.
Didn't
Good for you.
even pay attention to me. I don't wholesale all the time. I'm not a full-time wholesaler. I do more flipping and negotiations with my investors and that type of deal. So wholesaling is something I do pretty much on the side. And I made 6 figures on the side.
Thank you very much.
So
Thank you very much.
imagine if I really paid attention to this and did it. So it's good. So I teach people like Earl how to wholesale.
That's awesome. Awesome.
Yeah. I was
Well-
looking to get more into what you do.
Well, I could
And-
tell you when I met people, at first I was a little skeptical, well, I wanted to learn, but I also wanted to make sure it was real. So when I joined, I went and met with a bunch of syndicators and
Uh-huh.
just in Starbucks, like, individually. And I was like, tell me your story. And, is this real? And
Mhm.
I heard one after the other. It was like, change my life, change my life, change
Yep.
my life. My,
It happens.
my, and people were so open about their financial situation, which, in every other industry I've been in, people are kind of closed-lipped about how much savings they have, what's going on with their investments, and they're
People in real estate are open book.
a very open book. So, these guys were like, look, hey, my net worth was 500,000 and now it's 5 million. Like
Mhm.
another guy like drives up in a, nothing kind of car, walks in with shorts and a t-shirt and, like you'd never know anything. And now I had heard reputation wise from other people in the group that this guy had done very well for himself. And he's like, just take a guess what my net worth is. And I was like, 7, 8 million. He's like 11. And he started with, like a 24 unit
Yep.
deal. And then he didn't really go down the syndication route. This guy bought like a 24 unit, grew it, sold it for a big profit, and then did a 1031 and bought a 56 unit deal, and then grew that and sold it for a profit, and then bought a 70 unit deal or a 100 unit deal, and he just kept rolling it. And
That's
when
what
he
I have a group of clients out of Atlanta that do that. That's the reason why I chose Atlanta for my expansion, because the majority of my clients who invest in Buffalo live in Atlanta. So it's just easier for me to go down and wash, rinse, and repeat what we're doing here.
Yeah. So, I mean, like, look, you're a connector. I mean, I would say that, you need to find, that 3, 4, 5 syndicators that
Yeah.
are in that market that like to do deals in Georgia. And then the value that you bring. And so, the big multifamily space, everybody told me it's all about finding deals and finding investors.
Mhm.
So you either are the guy or gal that goes out and finds the deal. But if you're in New York and they're in Atlanta, doesn't mean you can't be the one dealing with brokers and analyzing deals, through
Oh,
the.
I know. I have my sister is also a real estate agent in Atlanta.
Oh, okay. So she can run out,
It's a
but
family business.
They got the whole family connected.
yeah,
Yeah.
you may end up finding like boots on the ground syndicator that is good at finding deals, but now prices keep going up, and when prices
Yeah.
keep going up, properties are getting more expensive, and if you have to raise 30% or 35% of the deal, then it starts getting harder for some people.
Yeah. I have a 24 unit in Warner Robins, Georgia, that I think is still available. I have to ask my client if he still has it available. My client's looking to sell it. So if you know
Fantastic.
anyone, let me know.
Yeah, fantastic.
Now,
Absolutely.
Darin, before we get cut off here, because
Sure.
tell the people how they can find you and follow you and your podcast and your social media.
Best way to reach me is my website, darinbatchelder.com. It's DARINBATCHELDER.com. I'm also on all the social media platforms. I like Instagram better than most of them, but I'm on LinkedIn.
I just followed you on Instagram too.
Oh, okay, great. I will make sure to follow back. So, would love to help out any way I can. What I would tell you is that, look, if you have the confidence, you can do it. Like, I've seen people come from all different backgrounds. Some were wholesalers, some were flippers, some were just business owners, some were engineers, some were tech executives. Like, it doesn't matter, it doesn't matter what your background is. If you believe that you can do it, and you just make a decision that nothing's going to stop you, then you will meet the right people, and you could do it just like everybody else can.
Absolutely.
Awesome.
All
That was
right, well,
awesome.
I'm done doing your interview for you.
I learned so much. I appreciate both of you. Delisa,
Absolutely.
this is my first opportunity, you coming on to our platform, and you really kind of allowed some of our guys who are not at that level, that high level that Darin is, to try to digest a lot of this really amazing content. So Darin, I really appreciate it. And I'm looking forward to maybe jumping on your podcast in the next 3 years as we scale up.
I would love that. I would love that. So I wish you guys all the success in the world. And if I could do anything to help out, just reach out.
I will
Very
do
well,
that.
thanks a lot. It was great
All right.
meeting you and having this conversation.
Absolutely.
Very informative.
Right back at you.
All right. All right, well, friends,
All
we're
right.
out. Another one's in the books. As always, this is Real Housing Relief, revitalizing our community, one property at a time. Thanks again, Darin. Thanks again, Delisa.
All
Have
right.
a good one,
Have a good
guys.
night.
See ya.
God bless. Bye-bye.
Bye.